I get on national TV and local TV. I haven't done a lot of national TV lately, but done a lot of local TV, cable channels and such. Of course, my own radio station. I probably do 4 or 5 interviews a month on radio. Different radio stations throughout the country, some syndicated, some not. But I'm not sure that there's anything that makes me a little more nervous than speaking to a group of 250 of my clients. So I got to tell you, thank you again for being clients. Thank you for your trust. And what I want to do is I want to just take the next 15 or 20 minutes or so and kind of talk about our core beliefs. And I want to talk about the market and kind of where we think it's going. Over the last 12 months, Providence has had record growth. If we look at our year-to-date growth at this point versus all of last year, we are up 38% at this point, Providence Financial. So thank you. But I have to say, the reason I mention that is that's because of you. 53% of our revenue last year came from you, either in the form of people that you wanted us to help them enough, people that you referred to us, or adding additional assets to your account. Once you realize that we're accomplishing what it is we said we would accomplish. So really, you're the ones to be thanked for helping us grow. And 53%, that's a lot. That's a lot. So thank you for your referrals, for sending people our direction as well. And yet, the reason that you trust us is because we have some core beliefs. And these are core beliefs that we don't want to waver from. And the primary core belief, there's really 2 primary core beliefs. One of my core beliefs is if you can live with worst case scenario, you can live with it. Okay, so we want to build a plan for you around worst case scenario. And a secondary core belief has to do with the fact that we're trying to protect your money. Okay? We're trying to protect your money and get you a decent interest rate without the risk of the stock market. We're not trying to help you get rich. We've never tried to help you get rich. But what we have done is we want to make sure that you never go broke. Okay, and that's the philosophy of our core beliefs. And how do we do that? Well, helping you invest for income and not growth. And I want to spend a few minutes and talk about that, something that we've probably talked about individually at some point in time. But the reality is that, I know for me, if I see a movie a second time or a third time or a fourth time, I tend to get more out of it. Okay, so I want to show you the movie a second time, and for some of you, maybe even a third or fourth time. But the success of your retirement has nothing to do with the stock market. The success of your retirement has nothing to do with how big your pie is. The success of your retirement has to do everything with how much income you can get. Okay? And that's important to understand because most advisors out there are investing their clients for growth, not income. And yet there's 2 fundamentally different ways to invest your money. You can invest for growth or you can invest for income. And when you're growing up in this world, meaning that when you're heading towards retirement, you're trying to grow your portfolio. Okay? You're trying to grow your portfolio. You're trying to scrimp, you're trying to save, you're trying to get as big of a pie as you can, get out of debt, so that when you get to retirement, you can start taking income from that pie, right? I mean, think about it for a second. If I gave you the choice of 2 pies, pie number 1 was $1 million, but you could only get $20,000 a year off of it for the rest of your life. Or pie number 2 was only $500,000, but you could get $30,000 a year off of this pie for the rest of your life. Which pie do you take in retirement? Am I right? Number 2, because it's about income. I mean, think about it this way. If I give you a piece of property that's worth $1 million, and you just get enough income from it to pay your property taxes and insurance, okay, what good does that pie do you in retirement? Any good at all? It doesn't do you any good. Retirement is about income. And yet, many of you were invested for growth when we met. And when you're invested for growth, what happens is the performance of your portfolio is going to solely depend on the share price, right? You buy mutual funds, you buy stocks, and the share price is going to go up or it's going to go down. But the performance of your portfolio depends on the share price. Income is secondary. You might get 1 or 2% dividends, but those are usually gobbled up with the 1 or 2% fees that you're paying as well. So ultimately, there's no income in your portfolio. The reason you buy a growth-oriented portfolio is for growth. so that the share price grows. Now, if you get into retirement and you're invested for growth and you want to get cash out of your portfolio to supplement your other sources of income, well, you've got to sell your shares, right? And if you sell your shares, what happens? You cannibalize your portfolio. You know, and that's a problem. And you know, the reality is that's the way that most advisors recommend. We took on a new client a couple of weeks ago because he had come to a workshop, and I had suggested that you live your retirement and you make enough interest and dividends from your portfolio to be able to live off of and satisfy your income needs in retirement without having to sell shares. And he had just visited his advisor before he came to see us. And his advisor said, oh yeah, you can get as much income as you want. We'll just sell shares as you need it. And he realized that was a major problem. Now, why is it a major problem? Well, people are living longer than ever, right? The problem is not dying too soon. People are living longer than ever. And there's some of you in this room are going to live another 30 years. Okay? There are some in this room that might make it to 100. I mean, the centenarians are the fastest growing age group around. And yet a lot of people don't realize if you live 30 years, what's really going to happen to your portfolio if you just take a little bit of principal each year. I hear people all the time say, well, I'm just taking 4% a year, so I'm going to be okay, right? The rule of 4%. Some of you have heard of that, where basically it says that that if you take, if you're invested in 60% equities and 40% bonds, and you take 4% a year, that your money will last you the rest of your life. And there are a lot of people that have bought into that, and a lot of people that are doing that. And they've never run a number to it, they've never crunched it, but they're taking 4% a year out of their portfolio. Well, if your portfolio is not earning 4% a year, then that means you're taking 4% a year out of your principal. And if you live long enough, what's going to happen? You're going to run out of money. Okay? And think about a mortgage for a second. Some of you, I'm guessing a lot of you have had a 30-year mortgage at some point, right? So think about, go way back when you got your first 30-year mortgage. Kind of exciting, kind of scary all at the same time, right? You get that first mortgage payment. Is that first mortgage payment, is that all principal or is that all interest? Oh my gosh. I remember the first time I had my first mortgage, mortgage payment, it was like $5 of principal. I'm like, how am I ever going to get this thing paid off, right? But then over time, you pay it, and you pay a little more principal, and you pay a little more principal. And a lot of you in here, I know, have paid your mortgages off. Okay? Congratulations. It's a happy day when you pay your mortgage off. But do you remember getting that last payment, right? That last mortgage payment? Is that last mortgage payment, is that all interest or is that all principal? It's all principal, right? And magically over 30 years, by just paying a little bit of principal 30 years earlier, you magically, got that mortgage paid off. Well, let's reverse it. If you have $500,000 in your retirement account or whatever that amount is, and you're just taking a little bit of principal every year to supplement your retirement, doesn't the same concept hold true? Won't you eventually deplete your retirement account? It's the same concept. It's the same principle. And that's the problem with investing for growth. You're forced to sell shares in order to satisfy your income. You're forced to sell shares. And that's the problem. Now, the rule of 4% has been around for really many decades. And it basically says you can get 4% a year out of your portfolio and not have to worry about running out of money. And there are people that have lived by that and believe that. And I personally know people that are starting to go broke because of that. But Morningstar just did a report, just ran some numbers. They did a report recently because they wanted to know if that was still true. I mean, interest rates are a little lower today than they were in the 80s, right? You remember double-digit credit cards and we still have double-digit credit cards, right? But you remember double-digit mortgages? You remember double-digit CDs, yes? Right? So when they came out with the rule of 4%, everyone was making 12 or 15% on CDs. That's not the way it is today. You get a good rate of return today at the bank. What is it, 1%? So the reality is, is that if you're only earning 1% but you're taking 4, where's the other 3 coming from? That's the problem, is it's coming from principal. Coming from principal. And Morningstar, when they did their study, they wanted to know what would be the maximum, what would be the best allocation looking at stocks and bonds to be able to give you a 90% chance of being able to make it through the rest of your life. Okay? And how much could you take out of your portfolio and really have a 90% chance of being able to make it? And the answer It's 2.8% a year. Okay? So if you have an equity-based portfolio and you can live on 2.8% a year, then great. Okay? But if you can't, if you need anything more above that, then the reality is you have to sell shares to get it. And that's the default. That's what almost all financial advisors teach. That's the default method. I'm one of the only financial advisors, maybe the only financial advisor that I know that is actually specializing in income. Because there's another way. It doesn't have to be growth oriented. You don't have to be invested for growth. You don't have to be in the stock market. Now, Wall Street doesn't want you to believe that, but really true. You don't have to be sitting at the Wall Street casino. And the fact is that when you invest this other way for income, as every one of you in here are invested for, it's not about the share price. Okay? The share price is there. You're still going to have a share price. The share price is going to fluctuate, but it's about the interest and dividends that you're going to be getting from your portfolio. Because our core belief is that if you're in retirement and you need to get money from your portfolio, then we want you to be able to get it from the interest and dividends that you're getting and not have to sell your shares so that when you get to a ripe old age, you don't run out of money. Why? Because you're not selling shares to satisfy your income. Does that make sense? Okay? And that's our core belief. That's our core belief. That's what we're good at. That's what we specialize in. I can tell you that the different investments we work with will pay you somewhere between 4 and 7%. Every person in this room is getting somewhere between 4 and 7% consistently and persistently in the form of interest and dividends that you can either spend and live on or I should say, reinvest if you're not at the point where you're taking your income. And the nice thing is you're doing that all without the risk of the stock market. And sometimes people waver. I've had some questions a lot, and I'm sure a lot of you have thought, well, the market's up 28% this year, and we're getting 5%. Is that good? Well, yeah, it's good because you're not sitting down at the Wall Street casino. Okay? You're not in that position. Most of you cannot afford to take the additional risk of Wall Street. And if the market's up 28%, absolutely. Could it have gone down 28%? What's the answer? And I've been standing up, or for those of you that have been to these or you've seen me, you know that really for about 3 years or so, I've actually been bearish on the market. And some people have asked me, well, has that changed? Are you, market's up, and has that changed? No, not one bit. I think it's going to be worse. I mean, it's almost like taking a balloon, looking at a balloon, and realizing or thinking that this balloon's going to get to this big. But then you keep blowing it up, and it gets a little bigger, it gets a little bigger, and gets real bigger, and it doesn't pop where you thought it was going to pop. But now all of a sudden, what's the logical conclusion? That it's not going to pop? Of course it's going to pop. I think the greater reality is that it's going to be a bigger pop at this point. And that's what I want to help you avoid. And it doesn't matter. And Wall Street wants you to focus on the short run. They want you to focus on the last year that the market's up 28%. But I'm not investing you for last year. I'm not investing you for this year. We're investing for the rest of your life. You have to look at the long run of what the market does. And you know that we've studied market history probably more than anyone else in this country, myself and a team of individuals that I work with. I sit on the board of directors of a company called Advisors Academy that does nothing but train other advisors nationwide about this stuff. And we've studied market history. And when you look at 200 years of market history, what you realize is that there are actually predictable and repeatable trends. Now, who here believes that history tends to repeat itself more often than not? Raise your hand. I know there's more than that because I ask this question all the time. So I know most of you, believe that history tends to repeat itself. And the reality is when you study market history, you realize that the trend that we're in has occurred many, many times over the last couple of years. So the question we have to ask ourselves is, what is the trend that we're in? Well, I believe the trend that we're in started back in the year 2000. Why 2000? Because all in the 80s and 90s, the market went almost straight up. But in 2000, the market crashed. Okay? Some of you remember the tech bubble crash, right, of 2001, and the market dropped almost 50%. Okay? And then the market recovered and crashed again in 2008, where the market dropped almost 60%. 60%. Okay? And it took until 2013 to get back to even. So from 2000 to 2013, the market was dead even, zero growth. Okay? And so now the market's up quite a bit, about 40% from 2013 to now. And people focus on the 40%. They forget what happened back in 2008. They forget what happened back in 2001. Okay? But they focus on the fact that we're up 40%, and a part of that is just what happened in the last year since we've had the Trump bump. Okay? And yet Wall Street wants you to focus on the short run. But if you go back to 2000 and you had yourself just an equity-based portfolio, 60-40 split, you realize that the stock market from 2000 to now, if you just bought and hold like they teach, has only produced you a little more than 3% a year over the last 17 years. Does that sound like a good inflation hedge? But I hear that all the time. People come to us and people want to be in the market because it's the only way to beat inflation. So the fact that the market hasn't dropped in the last 3 years, am I wavering? Absolutely not. It will drop at some point. It has to drop at some point. As a matter of fact, really, if the market doesn't go down by 40% from here, it's going to be breaking 3 Guinness Book of World Records that have been held for 200 years. You see, over 200 years, these long periods of time that have happened very frequently that often last 25 years. Every single one of these time periods has had at least 3 major crashes. And so far, from the last 17 years, we've only had a crash in 01 and we've had a crash in 08. We've only had 2 major crashes. We haven't had that 3rd major crash. And that's not surprising because we might have another 8 or 10 years to go in this current market. History has told us that. So we're waiting for that 3rd major crash. It just hasn't happened yet. The other thing is that most of the times the crashes have gotten successively worse when you look at these trends over Wall Street. Most of the times they've gotten worse. We've already had a 50% crash. We've already had a 60% crash. Is it possible that our next crash is greater than 60%? I think it's possible. But how much does it have to crash for you to be affected? 60%? How about 40%? I mean, if your portfolio dropped by 40%, I know that a lot of you in this room would not be in great shape. Would not be in great shape. And if you're selling investments to satisfy your income, well then guess what? Are you really going to satisfy your income? Are you really going to want to sell shares to satisfy your income if your portfolio is down? Of course not. And that's the issue. That's the issue. So over a long period of time, the market has had 3 major crashes every time, and the crashes have gotten successively worse. And no bear market cycle like we're in today, again, a cycle that could last 25 years according to history, no bear market cycle over the last 200 years has ever recovered without price to earnings ratios getting into single digits. And it's never happened. And I'm not going to give you a PE seminar. It just has to do with how expensive the market is. And right now the market is very expensive, very expensive. So really, if the market does not go down by 30% from here, then the market would be breaking 3 Guinness Book of World Records that have been in force for 200 years. Now, is it possible we're wrong? Sure. But if we're wrong, do you want to bet on the slim possibility that we break 3 Guinness Book of World Records that have been in force for 200 years? Or do you want to bet your money on the possibility, the probability that we probably have another major crash coming? And I know all of you have answered that question, that yes, we want to be safe. We want to be focused. We're not sitting down at the Wall Street casino anymore. We're not playing that game. So when the market goes up 28%, you're getting 5%. But guess what happens when the market goes down 28%? You're still getting your income. You're still getting your income. And that's very, very important. And the reality is all we've done is taken your money and put it to rent. We started collecting rent on your money. And some of you in here own rental properties. Okay? And there's 2 equations when you own a rental property, right? When you own a rental property, you've got the property itself, and that value is going to fluctuate, right? But while that value is fluctuating, you're getting rent. You're getting rent. And the rent's going to remain relatively consistent, right? So let me ask you, what's more important in that equation? Is it more important that the property stays the same at all times, or is it more important that the rent you get to spend every month stays the same? What do you think? The rent. Of course the rent stays the same. Now if you had to sell your property to get cash, if you had to sell your portfolio to get cash that you need, then it better be going up. But if your property drops in value and your rent stays the same, how much did that drop in value hurt you? It didn't hurt you at all. It didn't hurt you at all. And all we're teaching our clients how to do is how to collect rent on their portfolio, rent that you can spend regardless of the market conditions to supplement your other income and make sure that you're never going to run out of money. Does that make sense? Okay. And essentially that's what we're doing for our clients. And and I thank you for your trust in allowing us to help you do that. Investing can be emotional. And part of my job is really to help take the emotion out of it. Okay, really to help you realize that that if you come and ask me, should I sit down at the Wall Street casino? My answer is going to be no. All the time, because you need to know one thing about the stock market, and that's buy low and sell win. And right now we're at record highs. Okay, we don't know when the next crash is going to be. Raise your hand if you think there's, we live in California. Raise your hand if you think there's going to be another earthquake in California. We don't know when. We don't know how deep. We don't know what the damage is going to be. We just know it's coming. Okay? So my goal is to help you be prepared when that comes and to help you be the voice of reason, because you are investing right. You're investing for income. You're not sitting at the Wall Street casino regardless of what the market does. Does that make sense? Has that helped? Okay, good.